But let's join Olisa Namdi, a fixed income analyst from Zcrest Capital, for some analysis. Good evening. Thank you for coming to Capital Markets. It's your first time on the show, so we do really hope that you will give us a whole lot of information. But then bring us up to speed as to what happened in August in terms of the T-bill space and the bond space. You know, what happened to yields? We saw good movements, but when it comes to the auction by the central bank, once an OMO matures, the offering in terms of auction now reduces very to the barest minimum.
Okay, let me put it into perspective. So earlier this year, between late last year and early this year, we saw the DMO issue Eurobonds worth about $5.5 billion, and that was to refinance Treasury bills. So after that was done, we saw yield moderate significantly, down about 12.8% on bonds. At that point, we sent out a note to clients advising them that those yields were not sustainable and funds should not be locked up at those levels, because the key reasons and the key factors we were looking at were the pressures we saw in emerging markets due to trade tensions and policy normalizations by some global central banks. So in the month of August, in line with our expectations, the market was bearish, and we saw yields trend as high as about 111 basis points from their levels at the close of July. And the key factors there that affected the market was the same emerging market sell-off. We saw weakness in Argentina, we saw it in Venezuela, we saw it in Turkey, and the political risk sentiments within Nigeria. So particularly, there was the particular day when they had the blockade of the NAS. We had a lot of foreign clients calling and asking.
That sent out a kind of wrong signal about the market.
So then we witnessed a significant spike in yield. So yields lifted about 14% levels that particular time. Then from then on, the next thing that moved yields was the increase in FGN borrowings.
Yeah.
So the DMO came into the market. They had been managing rates for the past month, but because they had to finance the budget, and the budget is, they estimate to borrow about 1.64 trillion this year.
Yeah.
And as you know, the amount they had borrowed from they had raised through Eurobonds had gone with the last calendar of the bonds and the last bond and treasury bills calendar.
Okay.
So they didn't have enough muscle to manage rate at the last T-bills auction we saw in the month of August. Okay. So this caused rates to lift again above 15%. So those sentiments still played out in the treasury bills market. So the treasury bills market has largely been dominated by the central bank. Yeah. Central bank comes in once a week to do more interventions at 12.15%.
I think there should be another one on Monday or thereabouts.
Yes, there will be another one on Thursday.
On Thursday.
Likely to be another one on Thursday. There might be on Monday because of the amount of liquidity in the system. We expect FAC payment to come in.
So there will be more mop-ups.
Exactly. So we had seen in the treasury bills market, it has been stable for most of the month. But because of the PME auction, where the DMO had to sell all the sell to most of the subscribers, and we saw yields lift as high as 100 basis points from there. So subsequently, the market had been much stable for most of the month, trended significantly higher, and closed the month on a much bearish note.
So why are you bearish about the September and of course the Q3 as well?
So the factors we've been watching and we've been evaluating, we've not seen any significant change. So the economic indicators we saw, we were closely watching in the month of August failed to live up to analyst expectations. You saw the gross domestic product slowed down to about 1.5%. In capital importation statistics, you saw a decline in capital importation by 12.53% to about $5.5 billion. So we are seeing that the foreign portfolio investors are not coming into the market. Instead, they're taking funds out of the market. It's putting some pressure on the external reserve position of the central bank. And also, the debt management office needs to finance the budget. And they have so far raised about 500 billion, and they have about 1.64 trillion they plan to raise. And they also said that they plan to raise some Eurobonds. But with the way the market is and the general weakness in emerging markets, to be very difficult for the DMO to execute that plan to be able to raise Eurobonds at this particular time. Yields on Eurobonds are as high as between 6 to 8.5% across the curve. If the CBN is to go out, if the DMO is to go out to raise Eurobonds, you could see market players bidding as high as 9-10% for Eurobonds due to the general weakness in the emerging market. So that option may not be on the table for them. Then also political risk factors are still in play. So, and even local appetite for the bonds is weak. Because
but it looks like towards the end of August, we saw a bit of re-entry of more offshore investors.
Offshore investors didn't come into the market
at all
in the month of August.
Because some analysts will argue this. I mean, that there was a bit of re-entry as a result of the yields that was trending higher.
So there's a reason why yields were trending higher, and you know, whenever there's risk in the month of August, we saw increased trade tensions.
Right.
The U.S. was having trade spats with China.
Yeah.
Then elsewhere there was a confrontation with South Africa. And so on, several risk points. And once there are risk points, investors, and also we have expectations that there will be another hike in the US Fed funds rate in September. Mm-hmm. So all these things are showing you that the global central banks are taking out liquidity from the financial system, and yields are rising higher in global markets, while there are several risk factors that those global investors are looking at.
But this also tells us what we have right now with the yields trending higher means that the cost of borrowing is rising. I mean, for the federal government, is that not a concern?
It's a concern. So the federal government we saw the DMO ordinarily in the past months. The DMO has been able to successfully manage rates.
Okay.
I told you because they issued Eurobonds earlier in the year, and they didn't have to raise as much.
Yeah.
They could pay down and also manage rates. But towards the later part of this month, the funds from the Eurobonds proceeds had been used up. The debt management office has to raise funds to finance the federal government's budget. So they are under pressure, and they have to take rates at where market players come. Those are sentiments we say.
Okay, so general election is impacting the market, risk of sentiment in the global market. We're seeing all of that. How then do we finance or do we fund the budget now going forward, knowing that these two key factors are impacting sentiments?
Okay, so as to how the DMO plans to fund the budget, there's a lay-down plan, and they intend to borrow, and they will borrow. So at whatever rates they're able to get the funds, that's how they will go. I said that the DMO aims to have a 60-40% allocation to local and foreign debt, 60% to domestic and 40% to foreign. But I don't see them being able to tap into the foreign market this year because of I don't see, except maybe bilateral loans with some multilateral institutions.
Like the AFDB, World Bank,
exactly.
IMF,
but
and the rest.
To tap into the Eurobond market at this particular point in time.
And the federal government doesn't seem ready for that, actually.
Exactly.
But Olisa Nnamdi, thank you so much for joining us on Capital Market. We appreciate your insight on the debt market here. And I wish you a lovely weekend, a wonderful September, and a better profitable week next week. All right, that's the show for this evening. Thank you for joining us. We appreciate your time. I'm Temple Ashaja. I'll see you next time.